This is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Mark Mullins of Bonfire Ventures. Mark, thank you for joining us.
Thank you for having me. Appreciate it.
So, Mark, how did you get into early stage investing? What path led you here?
I'm sure everybody has a unique story. I grew up in Colorado, and my father was an entrepreneur himself. He was in the ski industry. He came from Iowa and grew up on a farm roughly. So he had a different upbringing himself, but he became an entrepreneur, was into the ski business, and then he got into electric toothbrushes, and then he got into restaurants, and he had a great career. But he, really almost never worked for anybody else. And I kind of learned that myself and enjoyed learning from my father. But after college, I was working for a company, a private equity firm out in San Francisco. And I met some engineers, which I didn't really know what that meant. This was late 80s, by the way. And they were building a computer program that allowed different networks to talk to each other. And if you can even understand, that's like allowing Oracle and Sun to talk to each other back then. And we thought that was cool, and I convinced my dad, and we invested $5,000, which sounded like a lot of money at the time, and we promptly lost it all. So it's kind of you got to have some spirit in terms of chasing these types of things, and you have to have some learning experiences, which we got early on that stuff. Eventually, I went to graduate school and came out and got a real unique opportunity to meet a gentleman who's known as Bill. His name is Bill Daniels. He's known as the father of cable television in the United States. Was a very famous, swashbuckling, unique entrepreneur, multi-billionaire by the time he died in 2000. And he started a cable television company in 1953 and then started an investment bank in 1958. And I joined him in the early 90s and was the head of international, which they had not done any international deals. And that was both in mergers and acquisitions and managing investments. And so ended up getting very busy in the early 90s. So busy that I ended up moving to Paris and then stayed there for several years, and then I ended up moving to London, stayed there for several years, met my wife, thankfully, and then moved to New York City. The headquarters for Daniels, by the way, was in Colorado and Denver, but we had offices in New York and other places. And so I stayed in New York City, eventually moved to LA, where my wife is from. The fund, the investments, the things we did very well. Bill Daniels himself died in 2000, but we kept the company going. And then we sold the company in 2007, luckily, to RBC Capital Markets, the big Canadian bank. And then we all took some time off. And in that time off, I was working for the city of LA. I was chief operating officer of the city. That's a sidebar conversation, but that really gave me a bird's eye seat to seeing what was happening in Southern California and that there was very little venture investing going on. And so I decided in 2002 to raise a fund called 2012, called Double M Partners. And we were going to focus on investing in early stage companies, primarily located in Southern California, where I thought there was a lot of opportunity. So I'll stop there for a second.
Well, great. Well, we've seen a tremendous rush of VC funding into Southern California. It sounds like you're on the leading edge of that, but what's driving the expansion of funding in Southern California in this time frame?
Well, it's basic economics. I mean, we're the second largest city in the United States. The economy is massive here. I think that for good or for bad, the headlines here for many years were dominated by entertainment, which is natural to understand. And so there was less thought put towards non-entertainment businesses, when the reality is that there's 10 million people just in LA County alone. And those people are driving a significant amount of commerce. And a lot of that commerce is driven by entrepreneurs. And that's the case in most of America. Most companies are small businesses run by families or individuals. And so there's a tremendous amount of that type of activity here. And I think it was just an undercurrent of things happening. As far as then the venture community jumping into LA, yeah, it started a little earlier, but really started to ramp up in the 2012 through 13, 14 period, et cetera, and to where it is today. And I think that the opportunities grow on top of opportunities. So as we started to see some exits, we started to see more entrepreneurs starting companies in Southern California. That creates a feeling for other people that they can start companies here. That creates a feeling for other investors that they can put money to work, and it really just builds on itself, right? It keeps building on itself. In 2012, I raised the first fund. In 2014, I raised the second fund. And in 2017, with my partner, Jim Andelman, who I'll explain in a second, we raised Bonfire Ventures, which is a $63 million fund focused on seed investing, which I'll explain more in a little bit. But Jim and I have been investing for many years together. He was running his own funds called Rincon Venture Partners. They were very similar to the same focus I had, which is investing in B2B software technology-enabled companies, primarily in Southern California. When I say primarily in Southern California, it's really about 65% Southern Cal and a good chunk up in Northern California. And we had been coming across each other in various deal flow and board meetings and relationships. And we kept talking about perhaps partnering. So it was a very nice organic way for two individuals who had known each other for a long time, but were running different platforms to come together and build a bigger opportunity, which was Bonfire. We partnered at the beginning of 2017. We raised the fund and are now underway and have 13 investments in that fund.
So what's a good focus for startups for your fund? What does Bonfire Ventures look for that you would think that would be a good fit for the fund? What's your criteria there?
Yeah, so we are what we call institutional seed investors. And what that means in our minds is that we tend to write, let's say, $1 million to $1.5 million check of a $2 to $2.5 million seed round, where in most cases, in the majority of our deals, we will lead or co-lead. Sometimes we take a board seat, sometimes we don't. But we're really writing a kind of a chunky check. We don't do a lot of deals. We do about 7 to 8 deals a year. And so we're high conviction. So we're writing those big checks and we're trying to take a big position in those companies. Let's say 10% is a target range. And in order to justify that type of investment from us, the company needs to have real traction, real progress. We're not very good at investing. Maybe there'll be a company who's raising a $600,000 friends and family round. That's not what we're good at. We like to follow those rounds eventually or come on top of them once the company has traction that's meaningful. And then we would need, therefore, in order to put that much money to work, some traction along the lines of, let's say, $50,000 a month minimum revenue. Doesn't necessarily have to be MRR, but MRR, repeatable revenue is what we like to say. And so they've got to have real traction with real customers that we can call. And the reason we focus on that traction is because we're really investing in teams early. In this early seed stage, as you know, there's not a lot of, it's not like I'm looking at years of financials, which I was very good at as a banker, but I don't really have that to look at. And so we're really evaluating both the market size, but really can this team execute? And that takes some intuition and some guts, but also some real traction for us to validate in terms of how they're able to execute on their strategy. And that's why, in seed investing, we really focus on the team. And particularly in the B2B area, the teams that we're seeing, generally don't tend to be in the younger side because they've been around for a while and they're building, more of a business-to-business focused enterprise. So we do have that benefit of dealing with teams that have had some experience or more experience than most, but we still have to make the bet on that team.
And how do you determine if that team is really going to execute? Of course, you watch to see if they are executing over the last 3-6 months, but how do you know they're going to work together well over the long haul? It's rare that you get a team that has been on their second or third group together as one team. It's always a new mixture, a new focus, a new area. But how do you know if that team is really going to go the distance? Because sometimes these teams break up because they have different views of the future.
Yeah, the secret is, right, we don't know for sure. We try to identify certain characteristics or patterns or conversations we've had with either them or their references, et cetera. We're trying to put together a whole bunch of lines and points of information to come up with a conclusion that suggests that the chances are higher than others that this team will actually be able to execute. And that takes experience and time and can, many times prove to be correct, but of course can prove to be incorrect. And so from the perspective of where do you get some of that intuition? I was, like I said, a banker for 20 years. I worked on different transactions in 30 countries. I lived in different countries. I banked and advised and partnered with entrepreneurs. That's what we did. These people were building businesses, much more higher capital intensive businesses, because they were mobile telephone businesses, cable television businesses, wireless, wireline, et cetera. But they were entrepreneurs from the start. And over that time, you learn to understand certain patterns or ways that you believe teams will behave or act. And you just have to apply that experience to anything you can grab onto, which is the business plan or the idea or the traction with customers. And my partner, Jim, who's also been around, he ran software investing for a big fund in the early 2000s. And he started his first Rincon fund in 2006. So we've just been around. Like, we feel comfortable with our own expertise of having had lots of experience with different entrepreneurial teams. So you have to start there, make kind of a gut instinct, or at least trust your gut instinct, and then add in as much information, whether it's market or customer information or strategy or technology, due diligence, all those things you add into the pile and make that judgment at the end.
Well, it looks like team is first, traction is second. If you had to pick the third one out of the list you just gave us, what would you think that third one would be that you look at?
Well, I think there's some intangibles that's hard to get across. So I would put that in the team part, which is dedication, guts, not being afraid, personal. Like we of course, naturally, we try to get to know them as well as we can in a short period of time. But we know people we want to be partners with. We're going to know these people or work with these people for 4, 7, 10, even 10 years. So we try to, have a little bit of humility about ourselves, but also try to find some personalities that we will get along with. I think the third thing that's important for us, if we get a ton of deal flow like other VCs, and we need to get through it quickly. So team, traction, where they're located, and amount of capital they're trying to raise, how credible they are in terms of identifying or laying out their strategy. And I think general, not every business should be venture backed. As a matter of fact, very, very small a percentage of the world's companies are venture backed, and that should continue. Just because you want to start a company doesn't mean it should be venture backed or needs to be venture backed. So we try to ferret out if there's a reasonable plan or justification as to why this company should be venture backed, and it can return venture type returns, I suppose.
Well, great. Well, it sounds like it's team, traction, and potentially tenacity is the third one that we look for as an intangible for who might be a good team member to take it all the way through to the exit. It sounds like you have a great deal going there. You have a good model. You have a lot of experience with it and so forth. What are some of the sectors that you're looking at and seeing the most traction in these days?
One of the areas we've been, for a while, been pretty active is really in HR tech, human resources tech. I think the entire stack of human resources has changed and is changing, starting from the fact that an HR manager or head of HR is a much more important part of the executive team of a company than they've ever been. Hiring people is hard. Keeping them is very hard. Hiring someone then not keeping them is very, very hard, and you lose money doing it. So if you want to break it down to being that simple, as particularly today with a 3% unemployment rate or whatever it is, getting the right employees and keeping the right employees is very, very important. So technology is now playing a much bigger part. It's no longer about reading a resume, et cetera, as you know. And so we are starting to find different platforms that are taking certain processes for HR management, and I'll cover a few in a second, and putting technology towards it, software, et cetera. So for example, we have an investment in a company called Branch, and Branch Messenger allows on-demand workers to exchange their shifts. So I'm going to use a real customer, which is Target. Target store has roughly 150 employees. Currently, or prior to using our technology, someone wakes up, their child is sick, or they have to go to school, or something happens, and they call in and say, I can't make my shift. And the manager of the Target store, or pick a restaurant, or any type of on-demand, shift worker platform, that manager then pulls out a list and starts to smile and dial. Says, hey, Paul can't make his shift. Can you make it? No, I can't make it. Calls the second person, calls the third person. So this removes and eliminates that entire process. So all the employees are on the platform. They turn on their phone. They go to the sign in. Can't make my shift. They put the shift out. The shift then gets pushed to all 149 workers that would fit that need. Then someone just pushes a button, says, I'll take that shift. And it automatically converts and changes into or ties back into the payroll system. So there's no sweat on the company and there's no sweat on the employee. Another way to look at it is using it. Let's say you've got a car payment. You want to put down money on a car payment. You want to pick up a bunch of extra shifts. You can go into several other targets around the area or anywhere and start picking up shifts. So it's a very unique way of helping the shift worker manage and the company itself manage their shift workers. So that's an example. Another company we have is called Fuel 50. Fuel 50 is a real enterprise software platform, major customers like banks and Caterpillar and Coca-Cola, et cetera, where an employee will start at the company and will go through a very intuitive, nice, I'm looking for a better word, but a very intuitive, nice platform of questions, survey questions, and it's all computerized, and it shows you and tries to really identify you as a person and what you really want out of your employment at the company. What are some of your goals? What are some of the things you want to be able to do? For example, you start in Sacramento and you really want to live internationally someday. Well, in that whole pathing platform, it's called pathing software. In that whole platform, you can identify the tracks or the things you need to accomplish to get to that job that's going to be in Barcelona in 4 years. And so that's the way that it makes the employee feel engaged with the company. And that also allows the managers to have always a 360 degree view and relationship and review of the employee going back and forth. So it makes in this era of, again, getting employees and keeping them, you want to allow them to feel, give them tools to feel engaged with the company and show that you have opportunity inside that company other than just the job you were hired for. So that's a quick example of a couple of HR things we're working on.
It seems like that's one of the high priorities of many companies is to manage the onboarding of employees, transitioning of them, and all the things that go around making them a happy employee as well. And as many industries move to gig economies, that locomotion of people through the system is just going so much higher and faster that you have to have some tech that really manages that process.
Exactly.
Well, so appreciate you sharing this information in the last few minutes that we have here. What else should we talk about?
Oh, well, some things I think about is just in general, as I may have touched on earlier, I think that being an entrepreneur is a daunting task, right? Like you really need to have it in you. I think you really need to think through the risks and opportunities. I have friends who have started companies in their early 30s or late 20s, whatever, and 10 years later, having worked really, really hard and made very, very little money, the company doesn't make it. And that happens. And we don't read about those very often, but it does happen. So I think if you're thinking about starting a company, fantastic. If it's in you to start a company, like you're just real determined, this is what you're going to do, that's fantastic as well. If you think it's kind of something that you might like to try, or it's cool, or you took a class at grad school that's called entrepreneurialism, really check yourself because those tend to be the real hard ones that make it. You're really biting into trying to fit a round peg into a square hole, right? Or square peg into a round hole, sorry. The tenacity that you really have to have, the champion of the spirit, as I like to say, champion of the entrepreneurial spirit. You can't teach entrepreneurialism. You really have to live it and be part of it. You really have to be willing to fight it out and take some of the risks that are personal risks, family risks, et cetera. And that's what not everybody's built to be building a company. We need a lot more people actually working at these companies.
Absolutely. It's a tough road for many and for all startups to go through. Appreciate you sharing these thoughts with us today. How best for the audience to reach you?
Yeah, so we have our platform, of course, info@bonfirevc.com.
Okay.
That's the way we look at deal flow. So
we'll put that in the show notes along with the website and hope to have you come back in the future and give us an update as how the investments are going and how the market is increasing there in Southern California. Appreciate your taking time and thank you so much.
Thanks, Hall. I appreciate it. Great program. I went through some of the other interviews you've done, so I really appreciate you asking me to do it.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Altice Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.